NUBURU stock is trading at exactly $0.1841 per share as of the market close on June 3, 2026 at 4 p.m. Eastern Time, marking a solid daily upside move of 6.72%. While casual market onlookers look at a sub-20-cent stock price and assume a company is on its last legs, something completely unexpected is brewing under the surface of this microcap stock. The business has quietly pulled off a massive corporate pivot that completely changes its risk profile, yet the broader public is still pricing it like a bankrupt component supplier. The core development that most retail participants have completely missed is a structural shift away from being a pure-play industrial hardware manufacturer and into becoming an integrated defense platform. By acquiring a massive 70% stake in the Italian electronics and defense firm Tekne and expanding its software capabilities through Orbit, this microcap company is trying to buy its way into a global defense pipeline projected to yield hundreds of millions in contract visibility over the next 4 years. When retail traders discuss online investing or scan popular investing sites for low-priced equities, the common assumption around NUBURU stock is that it represents an extreme lottery ticket gamble facing imminent delisting from the NYSE American Exchange. The expectation is that a microcap company with a history of negative equity and minimal revenue will inevitably dilute shareholders to keep the lights on. The reality, however, is revealing a meticulously executed turnaround plan. Just a few weeks ago, management announced a return to positive stockholders' equity, erasing a massive $15 million deficit from the end of last year to post over $2 million in positive equity, largely satisfying key exchange compliance listings. If you look closely at recent trading volumes and daily swings, institutional activity is starting to stabilize around these low levels because the downside risk of total insolvency is being actively mitigated by real contract-driven balance sheet adjustments. Understanding recent stock movement requires looking closely at how the market reacted to the company's first quarter earnings report. For a long time, the stock suffered from zero revenue generation, but the recent report highlighted its initial commercial revenue of over $400,000 alongside a drastically narrowed net loss. This initial inflow, combined with aggressive restructuring, lifted total assets significantly. For individuals using a self-investing model or utilizing an individual brokerage account on a standard trading platform, the stock's massive slide from its 52-week high of over $4 down to its current level looks devastating. But smart money, the kind you track through sophisticated online investment trackers, looks at the delta between past distress and current structural improvements. Macroeconomic pressures like high interest rates have hammered small-cap valuations across the board, pushing retail investors away from microcaps and toward megacap options like Apple stock or Nvidia stock. Yet this macro-driven sell-off has left a valuation gap where the company's market cap is sitting around $34 million, while its newly expanded defense platform is targeting access to massive projected revenue pipelines. Comment below how many shares of NUBURU stock you currently hold, or if you are entirely avoiding microcaps in this current market environment. To fully understand why this expectation versus reality dynamic is so stark, we have to look at what this business actually does. Historically, the company made its name developing high-power industrial blue laser technology, which offered structural advantages over standard infrared lasers for welding metals like copper and aluminum. Its business model relied on selling these specialized laser systems to automotive, aerospace, and consumer electronics manufacturers. While the technology was solid, industrial adoption was slow, capital expenditure cycles for major manufacturing firms were too long, and cash burn nearly destroyed the company. That older operating model is the reason why older financial reports look so ugly. Realizing that relying solely on industrial laser sales was a slow path forward, the company pivoted. It accelerated a dual-use defense and security platform strategy, integrating its blue laser surface treatment technology with directed energy systems, counter-drone defense applications, and electronic warfare capabilities. The proposed acquisition of Tekne gives them immediate access to heavy mobile defense infrastructure, while its increasing stake in Orbit adds a critical cybersecurity and software command layer to their physical systems. Looking toward the future outlook, the central tension for investors remains whether the reality of these ambitious acquisitions will manifest quickly enough to outrun the company's remaining cash requirements. Possible positive scenarios rely heavily on the regulatory approval of Italy's golden power filing process for the Tekne transaction, which would clear the path for the company to consolidate its share of substantial international defense contracts. Catalyst events to watch include the upcoming second quarter report, where management expects to meet an even higher stockholders' equity requirement to firmly put exchange non-compliance warnings in the rearview mirror. However, the risks are clear and shouldn't be ignored by anyone engaging in online investing. Microcap executions are notoriously volatile, and integrating overseas defense operations while maintaining strict cost control is a difficult balancing act. If the company successfully merges its high-power laser intellectual property with its newly acquired electronic warfare and software defense layers, the market will eventually have to reevaluate its valuation. If execution stalls, or if defense contract timelines drag out, further capital raises could still occur. When you look at this asset through the lens of modern portfolio management, it represents the exact kind of asymmetric bet that highlights the difference between casual retail trading and deep value research. Mainstream retail investors using simplified interfaces might look past a microcap altogether, focusing instead on high-flying large caps like Tesla stock. Wealthier investors utilizing institutional platforms or sophisticated services like Schwab Intelligent Portfolios tend to treat these positions as tiny, high-risk tranches within a broader, diversified intelligent portfolio. Whether you manage your assets through a comprehensive Fidelity brokerage account, trade fractional shares, or track your portfolio via advanced tools, the lesson here is that market narratives often lag behind corporate realities. The central insight for this stock is that the market is still punishing the company for its past failures as an underfunded industrial hardware vendor, while completely ignoring its current transformation into a contract-backed dual-use defense platform. The contrast between what the market expects, imminent insolvency, and what reality is showing, improving equity, new revenue streams, and major international defense partnerships, creates a compelling analytical gap that defines high-conviction microcap investing. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell, subscribe for more updates.